Leanne, coming to you from the office of Ascend Live. I'm going to be talking to you today about understanding retail sales tax. I find over the years that as I've been on the road and traveled that this is one of the most misunderstood concepts, especially for new consultants. So in this video, what I'm going to be teaching you is how the heck retail sales tax actually works, why you have to prepay it when you purchase inventory, and how the heck to understand it and make sure that you don't go broke in the process of replacing the inventory that you have actually sold. So let's go ahead and dive in and talk about what happens when you buy some inventory and how retail tax plays into that. All right, so let's assume that today you decide to purchase some products from Mary Kay InTouch. So you go out to the web and you buy $100 wholesale of product. Now, when that happens, you are going to be charged the tax, in the green here, on the amount that you actually will sell it for. So if you buy $100 wholesale, Mary Kay Corporate is going to assume that you're going to sell it for $200 retail. So you are going to be prepaying the sales tax as if you had already sold the full $200. And with that prepaid sales tax, what happens is Mary Kay collects it from you and then send it to the state for you under your Social Security number. So that way you don't find yourself having to go out and register for a franchise operation within your state or anything like that. You can just open up shop and start your business. And this is kind of a protection element that the company has put in place to make sure that the consultants don't get into trouble when managing their business. So your sales tax is taken care of, so to speak. Now that can be, there's an upside, and that is that you don't have to calculate how much you sold and actually send a tax return to your individual states. That's great. But the downside to that is you have to have all of the money up front when you purchase inventory to prepay the sales tax. And whether you ever sell that inventory or not, you are paying the full retail tax. So it's important that you understand that relationship between why when you purchase $100 worth of inventory, you're paying tax as if you actually purchased $200. So that gets assessed by your individual tax rates, and the company stays on top of what the percentage rates are by your state, so you don't have to. So just understand that when you buy inventory, that tax is then moved and paid to the state on your behalf. Now, what happens when you sell inventory? And you will. So when you sell inventory, what you need to make sure you're doing is charging sales tax on the inventory that you sell, because you're then recouping your cost. Now, this does not become part of your cost of goods sold. It's not part of your COGS. It's a recoup of the sales tax. So from a level of running your business like a business, understand that when you go out, and let's say you have a $300 class, okay? Now, from that $300 class, you are going to figure out what your cost of goods sold was, plus you're going to figure out what your tax was. And this amount is then rebudgeted, so to speak, so that you can go back over here and buy that inventory and replace what you actually sold. So it becomes a very important concept and a very important part of running a profitable and successful business is understanding the relationship. Now, let me help you also not make a mistake. And one of those mistakes that is often done in the Mary Kay business with the best of intentions is when you give a discount to a customer, actually making the choice to try to recoup all of your sales tax from the customer. Because by golly, you paid that tax and so you want to get it back from them. Most people have good intentions with that idea because they're trying to re-budget for themselves so they can replace the inventory. But they don't realize that that's actually an unethical and illegal business practice, because sales tax is actually what you charge based off of what you sold. In almost all states, this is true. I encourage you to talk to your State Department of Revenue to find out if it's different in your state, because there are a few exceptions, but by and large, with the majority of the states out there, if you charge sales tax in excess of what you actually sold them, that is illegal. Now here's a tip on what you can do. You can contact your State Department of Revenue and find out how to get the sales tax that you didn't collect from your customer back. So you can actually get a tax return on sales tax from your state. So don't try to get it over here from your customer. Try to get it from the state. Now this of course begs questions questions like, how do I track that? What do I do with it? So again, we're teaching you the concept here today. This concept then translates really well into helping you clearly see that you must have good records. IRS says that if you want to be in business, then you need to have good books and good records for your business. And here at Ascend, we have an amazing software program that manages all this and takes care of it for you. So if you don't like the idea of tracking the discounts and the sales tax and all that stuff, our financial software actually does that for you. But regardless of what our software does, it's very important that you understand why you prepay tax ahead of time, why you have to re-budget that tax instead of actually putting it in your pocket as profit, and why you shouldn't actually charge your customers retail sales tax on any discounts or hostess premiums or anything like that for your business. So run your business like a business, which means that you charge your customer sales tax and you charge them on the amount that you are actually collecting from them. Thank you so much, and we'll see you in the next video.